Okay, so in this chapter, we are going to cover what we call lean manufacturing. This is the process by which we try to limit the amount of waste in manufacturing. We improve our processes in business. We become a more lean, mean fighting machine in business, as we say. So we're going to cover what we call lean principles, lean accounting, and lean activity analysis. So let's go ahead and roll on through. So first, when we talk about the word lean, what does the word lean mean to you? To me, it means cutting the fat, as they say. You know, if you think of meat or even vegetables, when you cut part of the meat or vegetables, we're trimming it. And when you trim something, you're making it more lean. And so the same process, the same concept applies in business. And we talked about some of these concepts in previous chapters and in previous examples. So let's talk about what is lean. What are lean principles? In a lean enterprise or a lean business, this is a business that produces products or services that are of high quality, low cost, with fast responses, and are available immediately. Some examples of a lean enterprise would be things like a grocery store can be considered a lean enterprise because they have high quality products at relatively low cost. They're on the shelves quickly and they're available immediately. Well, most things are. That's the concept of a lean enterprise. Another example would be Coca-Cola. We talked about them as an example in previous class sessions. We talked about Coca-Cola's just-in-time manufacturing process, which leads me into my next item, which is lean manufacturing. In lean manufacturing, we call this just-in-time processing. This is where the company manufactures the product. In our example, Coca-Cola manufactures their Coca-Cola cans and bottles, and they deliver it through their various delivery channels in a just-in-time setting, meaning it hits the shelves just in time, just in time for the consumption, right? And so that's why a lot of times you won't see a lot of warehouses with a lot of inventory in the back. That's because they get it to the customers just in time. Another example of that would be Tesla, the auto manufacturer. Both manufacturing and non-manufacturing businesses use lean principles to accomplish these services and cost objectives. Again, lean, think of just in time. You know, it's high quality, low cost, fast response, and it's available immediately. So let's look at it from this perspective. When we talk about lean, we're talking about inventory, lead time, setup time, production layout, the role of employees, the production scheduling policies, quality, and suppliers and customers. And so each of these items have a process involved and various objectives, especially in manufacturing. The idea here is to reduce waste, to reduce inventory sitting on shelves, to reduce the amount of time it takes to set things up, so forth and so on. The concept behind anything lean is to improve efficiency. Efficiency, that's really the key term here, is to improve efficiency when we talk about lean processes. So one of the processes we discussed is reducing inventory. So what does this mean? We don't want inventory sitting on our shelves, wasting space and wasting funds, because as you know, inventory that sits a long period of time, we have to depreciate that over time, right? And so in order for us to prevent that from happening, we want to move it off of our shelves. So with lean manufacturing views inventory as a wasteful and unnecessary part of the process, and thus emphasizing the reduce or elimination of inventory. So an example of this would be with Coca-Cola that we discussed in previous examples. Coca-Cola manufactures the soda bottles and the soda cans, and they don't have this product just sitting in the warehouse somewhere. It just quickly, as quick as it gets manufactured, it gets onto a truck and it gets out to their customers, the grocery stores, the vending machines, so forth and so on. So therefore, the company has eliminated the need for having inventory on hand, or inventory available for sale. The elimination of that comes from the fact that Coca-Cola does not have a bunch of warehouses sitting with a bunch of inventory. So that helps to reduce cost as well, as you would imagine. So under traditional manufacturing, inventory often hides underlying production problems or problems caused by shortages of trained employees, unreliable suppliers, or poor product quality. Oftentimes, like if Coca-Cola did have a bunch of inventory sitting around, that's because there's a problem somewhere in the supply chain. There could be slow delivery methods from their trucking lines. There could be issues with their employees as they weren't trained properly, or there could be issues in the supply chain. So a just-in-time manufacturer like Coca-Cola doesn't have inventory because they don't have these types of issues. If they did, they would have these types of issues. In contrast, lean manufacturing solves or removes production process. This way, raw materials, work in process, and finished good inventories are reduced or eliminated. Now let's talk about this concept called lead time. We did talk about this briefly in previous chapters. I do want to touch on it again because I think it's very important. Lead time is oftentimes called throughput time. This measures the time interval between a product entering production and when it's completed. So going back to our example with Tesla, the start time is when we are moving our raw materials, our steel, aluminum, and parts to the manufacturing process. That's when we start the production process. And when it's completed, that's when it's rolling off of the assembly line. The finished car is rolling off the assembly line. That whole time it takes to manufacture it, we call it lead time. Measures how long it takes to manufacture a product. And so in manufacturing, we need to figure out ways to limit lead time or reduce lead time. And we do this by improving our efficiencies in the production process. So this picture shows us the lead time. In this example, it's furniture manufacturing. And it takes about 4 hours to manufacture a piece of furniture as it moves through the production process. The production process, as we see, it starts with raw materials being moved into the production process, first by sanding, cutting, and so forth and so on. Then it moves into the finishing stage, and then it moves into the fabrication stage, and ultimately becomes a finished product. This whole process, is, with the assumption that it's on some type of like smooth assembly line, takes about 4 hours. With just-in-time manufacturing or in the lean manufacturing process, we try to reduce lead time in order to improve efficiencies in business. So how do we reduce the lead time? So lead time is oftentimes classified in two categories. One is the value-added lead time, and the other one is the non-value-added lead time. When we talk about the word value-added, this is the time spent in converting raw materials into a finished unit of product. Non-value-added is, as you would expect, it's time spent while the product is waiting to enter the production process or is moved from one process to another. Clearly, we want to reduce the non-value added lead time. This is wasted time. And as you know, with wasted time is wasted dollars. So, as you might expect, there's a ratio that is used to compute the concept of value added. This ratio is calculated by taking the value added lead time and we divide that by the total lead time. And what are components of lead time? What goes into lead time? Well, as we know, lead time is the calculation of the production process. So it's the time taken for the production process. So we start production. Non-value time is when the raw materials are just sitting in the yard and being transported to another department. Value added time would be when we're actually processing those raw materials to turn it into finished goods in the various stages. And then of course, there's no value added when we're just transporting materials from one stage to another. But we do add value when we're packaging it and finishing it and getting it out to the customer. So this kind of shows us at what stages is value added and when is there not value added. So think of it this way. Value gets added to a finished good or the production process when there is production being done. So value added is the value is being added to the process when something is being done. If something is sitting still or is just simply being transported from one stage to another, there is no value added. Does it make sense? Are there any questions so far?
No.
Great. Wonderful. So let's look at it from an example. So let's say we have a lead time to manufacture a unit of product, and it's with the following. So here's the following lead time. It's highlighted for us. The value added is highlighted. The non-value added is not highlighted. So moving the raw materials to a machining takes 5 minutes. That's taking it out of your yard, your raw materials yard, and bringing it into the manufacturing process. That movement takes 5 minutes for the forklift to pick it up, move it into onto the assembly line. Machining is where we're drilling the raw materials. That's adding value to the materials. That takes 35 minutes. Then we move it from machining to assembly. That movement time takes 10 minutes. You get the floor jack, you pick up that materials, you move it to the next department for assembly. That process takes 10 minutes to move it. So there's no value added in moving product from one stage to another. The assembly, we're adding value in that process. It takes 20 minutes. And then after that process is done, we need to move it to the packing stage. It gets moved to the packing stage. That process takes 15 minutes. You get your pallet jack or your forklift and you bring it on over to the packing department. And so that process, the moving it takes 15 minutes, but then it's sitting in the packing department for another 30 minutes. The reason why it's sitting is because the process has to wait for the employees to pack the materials and then send it to their customers. And so the product will sit there for 30 minutes. And then the finished product will eventually get packed. The packaging process takes 10 minutes. So this tells us that it takes a total of 125 minutes for each product to go. That's the lead time for each product, 125 minutes. Does it make sense? Any questions?
No.
Great.
No question.
I understand it again. Can you repeat?
What's that, Val? You want me to repeat it?
Yeah, put in a better sense. I mean, just what do we do? Multiply.
I'm sorry, what was that?
Well, you got to move the raw materials to match in 5 minutes, and then you got matching 35 minutes. How did you get the 35 minutes from the 5 minutes?
How did I get 35? Oh, okay. So it takes 5 minutes for the forklift to move the raw materials out of the yard and bring it into the manufacturing process, the machining department. The machining department then drills the raw materials. Think of it like a press, they're drilling holes into a piece of steel. That process takes 35 minutes to do. Then they'll move that raw material, that drilled holes piece of steel to the next department, which is assembly. That movement on a forklift from the machining department to the assembly department, it takes 10 minutes to move that piece of steel.
Oh, okay. I follow you now.
Do you understand it now?
Yeah, I understand.
Yep. So all the highlighted ones here, that's when we're adding value to the product in the process of manufacturing. And then just moving it around and having it wait, it doesn't add value. So that's kind of shows us the difference. And then, but we still have to add all of these together in order to get the total lead time. And again, the lead time means how long does it take from the point that we start the process of manufacturing to the point where we end the process. That whole time it takes between point A to point B, we call that lead time. Very good. Any other questions? Good so far? Great. Okay, so as you might expect, there's some calculations involved when it comes to figure out the value added. So the value added ratio for the product is the following. We take, and this we're using the same example we just saw. We take the value added lead time and we divide that by the total lead time. As you know, the value added lead time is any time that we are impacting the actual product in production. This does not include things like moving it around. This is just any time that we're touching the product. So that first 35 minutes was the drilling. The next 20 minutes was the fabricating or assembly, sorry. And then that last 10 minutes was packing it. So that tells us that we spent a total of 65 minutes in adding value to the product. We also said that the entire lead time was 125 minutes. So we take the value added lead time divided by the total lead time, and that gets us to 52%. And that 52% is the value added ratio. Questions, or are we good? We're good?
Good.
Awesome, thank you. Okay, so we talked about lead time. Now let's talk a little bit about setup time. So as you already know, setup time is the time it takes to prepare the operation or the process. This is, we got to retool the machines, we got to set up the machines, we got to clean the shop floor, so forth and so on. This is all a part of setup time. We're preparing the assembly line for the processing, okay? And so in lean manufacturing, one of our objectives is to reduce the amount of time it takes for these types of processes. So one method that we use in order to reduce time is we do things in batches. And we talked about this in earlier chapters as well. So in order to batch things, we create what's called batch sizes. This is the amount of production in units of product that is produced after a setup. We call that a batch size, also known as a run size. So the total within the batch time is computed by taking the value added time and we multiply that by the batch size minus 1. Now, as we already know from the value added ratio, we take the value added time, lead time, divided by the total lead time. In lean manufacturing, the whole idea here is to reduce setup times in order to reduce the batch size, sizes. Whereas in traditional manufacturing, we treat setup improvement as an important priority. So conceptually, the idea behind reducing the setup time is to save time, which saves money, right? That's a whole idea behind becoming a lean manufacturer. So what's the relationship between setup times and lead times? Long setup times lead to large batch sizes, which leads to large inventory, which leads to longer lead times. The idea behind lean manufacturing is to reduce all of these things. So if we reduce the amount of setup time, we'll ultimately reduce the amount of batch sizes, which hopefully will reduce the amount of inventory that's sitting around, which will also reduce the amount of time taken throughout the manufacturing process. So let's look at it from an automobile manufacturer process. So this company manufactures engine starters. They're a components company. And then they sell those engine starters to the larger auto manufacturers like your Tesla or your Ford or your GM or whatever. And so this company manufactures the engine starters, that little component that goes into each engine to start it. So here's their process, their lead time or setup time. So first they move raw materials into the machining process out of their raw materials inventory. They move it into the machining process. Machining process takes 7 minutes. They then move that to the assembly process. The move time takes 10 minutes. Assembly process takes 9 minutes. Then they move it into testing. The move process from assembly to testing takes 10 minutes. The testing process takes 8 minutes. That gives you a total lead time of 49 minutes. And in that 49 minutes, we're saying we can produce 40 units. Okay, so the lead time we calculate we have our value added 24 minutes. That's 7 minutes in the machining, 9 minutes in assembly, 8 minutes in testing. That's 24 minutes of value added time. Then we have movement time from each area or department, 5 minutes, 10 minutes, and 10 minutes. That's moving it in between each department. The total within batch wait time is 936 minutes. In other words, this process, 49 minutes for each unit, okay? And then we're saying we got 40 units running through that process. So you multiply those two together, we're looking at 936 minutes. Okay. And so how do we get the total batch within time? We took our value added times, we multiplied that by the batch minus 1. We got our 24 minutes per unit times the 39 units with the batch, gets us 936 minutes. So you add your 936 minutes plus your value added plus your move time to get 985 minutes. Then we need to figure the value added ratio for the setup time. So we have our value added lead time, which is 7 minutes for the machining, 9 minutes for assembly, 8 minutes for our testing, divided by the 985 minutes total lead time. Gets us to 2.4%. Any questions so far? Hopefully it makes sense. It's really just the same concept. It just includes the when we're talking about batching.
Got it.
Got it? Great. Okay. So let's talk a little bit about the products themselves in the manufacturing process. How are they organized? Now, in business, especially in lean manufacturing, which is what we're talking about with this chapter, we want to be able to reduce the total amount of time. That's the whole concept behind becoming lean. So one way we can become lean, and this principle also applies to our lives as well in business, is to become product oriented. So what does this mean? How things are laid out improves efficiency, right? Manufacturing process can be organized around the product. We call this product oriented layout or product cell layout. The concept here is, if I organize my processes, my products in a logical way, I can reduce the amount of time it takes in order to go through the process. So think of it this way. If I have all of my raw materials at the very beginning stage, my yard, if I have my yard very close to the first entry point, meaning the machining stage, if the yard is very close to the machining stage, I'm reducing the amount of time it takes to get the raw materials to that machine, right? And so the shorter amount of time that takes, I'm reducing that amount of time. I'm becoming more lean in the manufacturing process. And then if I reduce the amount of time it takes to get from the machine to the assembly stage, with that logical layout, I'm improving the overall efficiency and I'm becoming more lean in the manufacturing process. So that's the whole concept behind process-oriented layout. You got raw materials close to your machine, which is close to your assembly, which is close to your packaging. That logical flow of the materials, that is the process-oriented layout. And so the more logical that flow is, the more lean the manufacturing process becomes, because you're taking less time in that process. So manufacturing process can be organized around these processes. Lean manufacturing normally organizes manufacturing around products rather than processes. So again, the more logical the flow of the product through the process, the more lean the manufacturing concept becomes. Does it make sense? Hopefully. Yes. Wonderful. Thank you. Vote for Lorena, by the way, if you haven't already.
Okay. I was going to say.
Okay. Employee involvement. In business, it's very important to involve your people on the front line. Why? It's because oftentimes they come up with great ideas, okay? And they oftentimes know better than management does. So employee involvement is very, very important, especially in the manufacturing process, because they oftentimes come up with ideas in order for the company to become more lean in the process. It makes their jobs easier. So it's kind of like an employee comes to you and says, you know what, we have this process, like Elias, for example. He's got this new job and he's doing accounts payables and receivables, right? And so in Elias's job, he probably has a process for accounts payable. First, he gets the invoice from the supplier. He then attaches the purchase order to the invoice. He attaches that to the bill. He then prints the check. The check then goes for a couple of signatures. That's a long process. Okay, so Elias might say, hey, you know what? I got a better idea to help streamline this process to reduce cost and to reduce time, to become more efficient, right? And so Elias might say, you know what? Instead of this flow, what if we did everything digitally, where we just upload all of these things, and so that way, instead of me mailing the check for signatures, What if we just sent the check directly through a digital process for signatures, right? So something like that might reduce time and efficiency. So with Elias's involvement in coming up with those ideas, the company might be more responsive, right? So employee involvement, it's management's approach that grants employees the responsibility and authority to make these types of decisions about operations. Employee involvement is often applied in lean manufacturing by organizing employees into product cells. Within each product cell, or again, product cell is another word for product-oriented layout, right? Within each product-oriented layout or product cell, employees are organized as teams where the employees are cross-trained to perform any operation within that product cell. So in Elias's situation, Elias is trained in both accounts payable and accounts receivable. So from that perspective, he can do both functions, which makes the organization more efficient. So any questions on employee involvement? Should make sense, right? Great. So now let's talk about what we call push and pull manufacturing. So, and again, all of these concepts help the organization become more lean in their processes and manufacturing. In pull manufacturing, we call this made to order. Made to order, okay? So it's kind of like, you know, you go to Five Guys and you want your burger and fries, right? So when you pull up to the Five Guys and you walk inside and you're like, you know, I want a burger and I want some fries, they make it right then and there in front of you. Okay, so that's made to order. You go and you place your order, you wait a little bit, they make it in front of you. That's made to order. That's called pull manufacturing. The same concept applies to pretty much most fast food establishments in a general sense, or a restaurant to that matter. They use pull manufacturing. Products are manufactured only as they are needed by the customer. Right? So you go and you place your order and they make it for you. Okay? Products can be thought to be being pulled through the manufacturing process. When you place that order, it goes through the manufacturing process after the order is placed. It's as needed or made to order. That's called pull manufacturing. Now, the opposite is also true. In traditional manufacturing, think of this as like your auto manufacturers that build up inventory. When they build up inventory, this is called push manufacturing. The traditional approach is called push manufacturing. It's based off of customer demand. So in this principle, it's called push manufacturing. It's where they build up inventory based off of consumer demand. Does it make sense? Any questions? Good?
We're good.
Awesome. Thank you, Joel. Okay, I talked about this one. This is a great topic. Zero defects. This is the objective of any manufacturer, is to eliminate poor quality, to eliminate errors, to eliminate waste. All this is accomplished in lean manufacturing. The best company example I can give you when it comes to this process is Nike, the shoe company. Nike employs what we call Six Sigma. It was originally developed by the Motorola Corporation. Six Sigma is a concept that improves product quality and manufacturing processes in 5 steps. We define the process, we measure the manufacturing, we analyze the quality, we improve the design, and we control the output. So in these steps, what Nike has efficiently done is that one in every 6 million shoes that Nike manufactures has a defect. 1 in every 6 million. That's why we call it Six Sigma, 6 million. 1 in every 6 million. That is extremely efficient. They have it down to a science. And they've identified these 5 steps in the manufacturing process. You define what your process is. You measure the production process. You analyze the production process by quality control measures. You improve the process by eliminating waste wherever possible and eliminating time wherever possible. And you control the outputs. And so Nike, a shoe company, has gotten very efficient at utilizing Six Sigma. Everyone understands? This is a great process. Wonderful process. Great. Okay, so that leads me into my next concept, supply chain management. This is the foundation of almost every business, supply chain management. This is the coordination and control of the flow of materials, services, information, finance with suppliers, manufacturers, and customers. The flow of information, the flow of materials, the flow of services. In supply chain, this is what makes everything run efficiently. When supply chain is in order and everything is logical and everything is flowing consistently, the supply chain is thought to be healthy. Supply chains encompass just about everything we do in business, both with services and with materials, so forth and so on. So you look at today's example, I would say like the N95 masks that our healthcare workers are utilizing. There's a supply chain issue going on right now. The supply chain issue is that there's not enough of these materials to go around. There's not enough of these finished goods to go around. And so the manufacturers are trying to catch up with demand. And so in this process, the manufacturers need more material, they need more elastic bands, they need more of the cloth materials that are utilized to make these masks. And so their supply chain, these manufacturers are relying on these suppliers to be able to get these raw materials in, right? And so right now we see a problem with supply chain where those suppliers just so happen to be based in other countries that are being impacted by this virus. And so now there's a problem we see with the supply chain. So other manufacturers are quickly scrambling to figure out ways to improve the supply chain to get the flow in properly. And so with supply chain management partners, what suppliers are using, they use what we call long-term agreements. These are agreements that with the suppliers will say, listen, I'm going to send you 1 million of these pieces of material over a certain amount of time. That's called a long-term agreement. So these agreements ensure that products are delivered with the right quality, at the right cost, and at the right time. Okay, so further looking at the supply chain, to enhance the interchange of information between suppliers, customers, and supply chain management. In supply chain management, we use these 3 most commonly used elements. We have the electronic data interchanges. That's just a fancy term for we use computers to communicate with each other, relay information, and receive payments from one organization to another. Of course, computerized payments improves our industry processes where we don't have to wait on the mail for a check to come. We can just simply get a direct deposit, right? So that's electronic data interchange. We also have what we call RFID chips. These are radio frequency identification devices, which are like electronic tags. They're placed and embedded within products that be read by radio waves. This is a great way for companies to control their inventory and their assets, right? For example, at UDC, our computers have RFID chips in them. So the university always knows where their computers are, right? And this is a great way for the university to maintain knowledge of where their assets are. And then we have enterprise resource planning, or ERP. These are computer systems that are used to plan and control internal supply chain operations. Any questions on supply chain?
Nope.
No? Great. That's a good concept to understand. Absolutely. Okay, so now we talked about all that was about manufacturing. Let's talk a little bit about non-manufacturing processes. In manufacturing practices, these are often adopted by other industries that are non-manufacturing, like hospitals, banks, insurance companies, and hotels. Or administrative processes like insurance applications, product designs, and sales orders. Here's an example from the hotel industry I can give you from my experience working in hotels for 15 years. So in my experience of working in the hotel business, we had very similar processes. For example, if we placed an order with Cisco for food for our restaurant in the hotel, we would, call up Cisco or place the order through their website. Cisco would then, in the next day or two, deliver the order. With the order would be a packing slip. The bill would come either in email or mail that same day or the following day. We would process that in our ERP, our enterprise resource management software, and then we would pay that bill. It's very, very efficient. Once you have these efficient processes in place, you become more lean. You save a lot of time, which saves a lot of money in the process. So that's my example from the hotel business. In a lot of cases, these service businesses, which are the products for our customers or for our patients or our guests in the hotel business. In these cases, administrative processes are the products are normally in terms of information. So here's an example. Let's work through this one together. So here's the question. Which of the following are features of a lean manufacturing system? Is it A, reduced space, B, larger inventory, C, longer lead times, or D, reduced setups?
D.
Taylor says D. Well says D.
D. D too.
Say D as well, Elias. Okay. Joel? Yep. Okay.
Is D the answer or C?
I doubt it's C. Why would you think it was C, Val?
Because everything he was basically talking about is something about. No, I'm wrong.
Read the words. Lean manufacturing.
I'm wrong.
Okay, so we know that it's not
Reduce setups.
setup. Okay, so you think D. Okay, so here are the options again. We have reduced space, larger inventory. We know it's not larger inventory because the whole idea behind lean manufacturing is to reduce inventory. Longer lead times, we know that's not true because the idea is to reduce our lead times. So the correct answer here is either A or D or both.
Oh, okay. Reduce space.
I would have accepted either reduced space or reduced setups. Here's why. Reduced setups, sure, that makes sense because reduced setups, I'm reducing the amount of my lead time in the same process, right? With reduced space, I'm paying less in rent, okay? I am being more efficient by not having inventory in that space. So I would have also expected reduced space as a possible answer. So again, anytime that you see lean manufacturing, the idea behind it is that we're reducing something. We're making something more efficient. So A or D would have been acceptable answers here.
Okay, is that going to be on the test?
No, because we don't have multiple choice. We do have multiple choice, but it'll only be, it's not multiple answers, just multiple choice. So, but it might be a part of a matching question. Very good. That was a fun one. Okay, So we talked about lean manufacturing. We talked about other lean businesses. Now let's talk about lean accounting. In lean manufacturing, the accounting system reflects a lean philosophy. Such systems are called lean accounting. This has the following characteristics. We have fewer transactions. We have combined accounts, non-financial performance measures, and direct tracing of overhead. These all make up lean accounting. Now, within the combined accounts, we have our work in process accounts. We combine those with raw materials. I'm sorry? What was that? Okay. We have combined accounts with raw materials. All those together can be combined into one account just to make things more efficient. We also have direct labor. Can be combined with other costs to form a new account called conversion costs. And that's the concept of lean accounting. It's just basically less transactions is the point that we're trying to get across here for lean accounting. So having fewer transactions, what does this mean? As you know, with the traditional accounting system, we have a lot of processes and a lot of movement across departments. So the recording of product costs by departments facilitates the control of costs. However, this requires a lot of different transactions, and the costs be recorded and reported, which adds cost complexity to the accounting system. In other words, the more transactions there are between movement of materials from one department to another, there's a lot, of course, more transactions. In order to limit that, we might combine the transactions together into like a few journal entries. In lean manufacturing, there are less need for cost control. So because of this, there's less inventory levels, which make other problems more visible. It's a good thing. In lean accounting systems, we use what's called backflush accounting. Backflush accounting is where we make things simplified in the accounting system by eliminating the accumulation of transfer of product costs by departments, and instead of that, we pull materials and conversion costs directly into the finished goods. It's basically a way of streamlining things, making things a lot more simpler. So when we combine accounts in lean accounting, we debit all materials and conversion costs into an account called raw and in-process inventory. Basically combining raw and in-process inventory together into one account. The lean manufacturing often does not use separate direct labor cost classifications. This is because employees in product cells perform many tasks which are, as you know, cross-transferable or cross-trained. These are classified as direct, and some are indirect labor. So the labor costs of direct and indirect labor are combined with other product cell overhead and recorded in an account called conversion costs. We learned about conversion costs in earlier chapters. So in the combining, here's an example. Here's an example of a company that manufactures sheet metal. So this manufacturer for electronic testing equipment has annual budgeted conversion costs of $2.4 million and 1,920 planned labor hours of production. So what are the conversion costs? Conversion costs, as we learned in earlier chapters, is the budgeted conversion cost divided by the planned hours of production. Our conversion cost rate, we take our $2.4 million in budget conversion cost divided by 1,920 planned labor hours to get us to $1,250 per hour. That is our conversion cost rate. So cell conversion cost rates are very similar to predetermined factory overhead rates that we learned about in the previous chapter, except that it includes all conversion costs in the numerator. So let's assume that the cover product sell rate requires 0.02 hours of manufacturing of time per unit. So the conversion cost would be computed as following. Manufacturing time is 0.02 hours per unit times $1,250 for the conversion cost rate. To break it down into units, it's $25 per unit of conversion cost. This just kind of recaps the same concept that we learned about of conversion costs in earlier chapters. So what about non-financial stuff? So in lean manufacturing, normally non-financial measures help us to guide short-term operating performance of the company. Non-financial measures are operating information that helps the information that has not been stated in terms of dollars. These would include things like lead time, value-added ratio, setup time, the number of production line stops, number of units scrapped, the deviation of scheduled production, and the number of failed inspections. These are non-dollar items, but we use these items to help the managers to make operating decisions in order to get the company into more lean manufacturing. So most companies use a combination of financial and non-financial information, which are often referred to as KPIs or key performance indicators. This is a very common term that you'll see in business. You probably learned about this in your intro to business course, KPIs, key performance indicators. Since non-financial measures are often available more quickly than financial measures are, they are often used on day-to-day operating decisions that require more quick feedback. In contrast, the traditional financial accounting measures are often used for long-term operating decisions. So what about tracing overhead? This is another method of reducing our overall lead time, which makes us a more lean manufacturer. So in lean manufacturing, many indirect tasks are assigned to product sales. Thus, the salary of maintenance and personnel can be traced directly to the product sale and thus to the product. In traditional manufacturing, as we know, that's not the case. That's just attributed to factory overhead rates. So the cost of the maintenance department is allocated to products based on predetermined factory overhead rates. So how do we analyze the activities? Activities can be used to support the operational involvement of the lean enterprise activity analysis. Activity analysis is used to determine the cost of activities for the purpose of determining the cost for quality, value-added activities, and processes. Very similar to what you learned in activity-based costing in the previous chapter. So let's talk about the cost of quality. Cost of quality is where competition encourages businesses to emphasize high-quality products, services, and processes. Through this, we incur the cost of quality. It's kind of like the cost of doing business, right? So cost of quality can be classified as prevention costs, appraisal costs, internal failure costs, and external failure costs. Prevention costs are costs of preventing defect before or during the manufacturing process. Appraisal costs are costs of activities that detect, measure, and evaluate and inspect products and processes to ensure that they meet the customer needs. It's kind of like auditing, right? Internal failure costs are costs associated with defects discovered before the product is delivered to the customer. And external failure costs are the costs incurred after the defect has already been delivered to our customers. We definitely want to try to avoid those as much as possible. It's kind of like, you ordered a new TV online. It got to your place, and it turns out that the specs, there's something wrong with it, and so you send it back to the company. That's an external failure, and the company has to pay for the warranty. They have to pay for the cost of repair or replacement. Internal failure cost would be something like the company realized that there was something wrong with the manufacturing of that TV during the process. So here's a nice visual representation of this. Cost for controlling quality. Again, prevention costs. How do we prevent failures from happening? Appraisal costs. This is kind of like our audit. And then costs of failing to control quality, external failure costs, and internal failure costs. If I realize the TV is broken before I send it to my customer, then that's an internal failure cost, and I have to remanufacture it. External failure costs is where I've already sent it to my customer. My customer noticed it was broken and then sent it back. Just a little bit more about the cost of quality. Prevention and appraisal costs can be thought of as cost of controlling before any products are known to be defective. And internal and external failure costs can be thought of cost controlling of quality after the products have already become defective. And here's a nice visual representation of this concept. So we see that the more that we prevent any type of failures from happening, meaning we're inspecting the product, we're testing the product, we're doing everything we can to prevent any types of failures in our manufacturing process to get to that Six Sigma point. We see that the cost of doing that, of course, increases over time. But we also know that the more that we invest in that process, the lower our costs become for internal and external failures, and our total quality costs also decrease with the more cost that I invest into producing a very good product. The activity analysis for quality quantifies the cost of quality in terms of dollars. I want to show you a method that we look at in terms of reporting quality costs in information. We do this through what we call a Pareto chart. This is a bar chart that shows the totals of that are attributed to the number of categories. This chart is used by managers for a quick visual tool for identifying the most important quality control cost categories. And here's what that chart might look like. We have a rework category, warranty work, disposing of scrap, disposing of rejected materials, processing return materials, finishing good inspections, preventative maintenance, materials inspection, design engineering, and assessing vendor quality. All of these costs are looked at by management in order to become more efficient through lean manufacturing. And so the more I'm able to control these costs, the better it is. So managers look at these types of charts in order to control their quality costs. And so we can look at this information through a report as well. The cost of quality also can be summarized in a quality report. This is called a cost of quality report, and it shows information of total activity costs for each quality cost classification that we just saw in the Pareto chart, the percent of total quality associated with each classification, and the percent of each quality cost to its classification to sales. And here's how that looks from a report perspective. We see the classifications here on the left, the total quality costs associated with each category, the percent of total quality costs, and the percent to total sales. And we can also analyze information in terms of value-added activities. This type of information can be classified as value-added and non-value-added activities. The activities that are necessary to meet customer requirements are known as value-added, and those that are not occur because of mistakes, errors, omissions, and process failures. So in business, we need to constantly analyze ourselves in order to become more lean in processing. And so we do this through process activity analysis. And a process, as you know, is a series of activities that converts an input to an output. Management can use process activity analysis to improve our processes. And most common business processes include procurement, which is the purchasing of materials, product development, manufacturing, distribution, and sales order fulfillment. These are very common business processes. We would analyze each process in order to become more efficient in business, become more lean. So here's a nice graphical representation of this. We have our sales orders submitted by customers. We would check our customer's credit to determine whether to fulfill the order or not. The order gets into the computer system. Somebody in the warehouse picks the inventory from the warehouse, and then we ship the order to our customer. The product is received by the customer. All of this is the sales order fulfillment process. This is what that process looks like visually. And time for an example. Okay, so Mason Company incurred an activity cost of $120,000 for inspecting 50,000 units of production. Management determined that the inspecting objectives could be met without inspecting every single unit. Therefore, instead of inspecting the 50,000 units, we can inspect about 20% of those units. Determine the inspection activity cost per unit on 50,000 units of total production for both before and after the improvement. So, who can tell me what would be the inspection activity cost per unit? So 50,000 units. We said that the activity cost is $120,000.
120.
What was it, Elias?
$2.04.
I'm sorry?
$2.04.
$2.04.
40. I'm sorry.
$2.40.
I mean, we're dividing the cost by the units, though.
That's right.
Yeah, 2.40.
You're correct. $2.40. And so that's if we do every unit. And then if we, as we see, we revised it, right? So we revised it down to only inspecting 20%. So at first we did every unit, 50,000 units. That's $2.40. Then we said, hey, you know what? In order to be more efficient, we're only going to inspect 20% of the units. So in order to figure that out, we would take our 50,000 units times 20%. That would get us to the number of units that we would inspect. And we would multiply that by the $2.40 to get us to get us down to 24,000. 24,000 divided by the 50,000 units would be 48 cents per unit. Yeah, that's a good example. I like that. Okay. And that, my friends, is the end of the chapter.
Cool.
Yay.
Yay. Made it. Questions on anything we covered in the chapter?
I have two questions.
Yes, Marcus.
Direct tracing of overhead in lean manufacturing, many indirect tax or assigned to a product sale. What are product sales?
Let me see if I could get to that part of the slides. Direct tracing. Okay. So Marcus, I'm sorry. Can you repeat your question?
What are product sales?
Oh, product sales. So product sales are the product sales is another word. So when we talk about sales, we are also talking about the production process. And so sales, and we talked about that in the earlier slide, because let me get to it. Sales. I want to make sure I give you the right term. Sales are here it is. The product-oriented layout. So Marcus, the product sale is another word for product-oriented layout, meaning it's how the shop floor is laid out. So Marcus, if you think of it this way, when I am tracing my product, I just want to get back to that slide so that way when I talk about it, it makes a little bit more sense. Okay, so when I'm tracing the overhead in terms of product sales, what this means is that I can allocate the overhead to the layout of the shop floor. So when I look at my overhead, I can attribute that to the area of which I have my raw materials. I can attribute the overhead to the assembly line process. I can attribute the overhead to the finished goods stage. And I can attribute it to the finished goods. So what this tells us is that in lean manufacturing, the indirect tasks are assigned to the product layout. Does that make sense, Marcus?
Now,
Great, awesome. Thank you so much. That was a good question.
will there any math questions on the final? Any math questions on the final?
No, sir. I have removed those questions from the final exam.
Okay.
Good question. Thank you. Great. Are there any other? As you know, this was our last lecture together. I will be hosting a final exam review session that is optional. I'll be hosting that on the 21st of April. This coming Thursday is a holiday, so we won't have class, which is why we had to move this chapter to today. The 21st, we'll do an optional review session. The final exam will be open on the 23rd and the 24th. I would highly recommend that you try to take that final exam as early as it's open. Just from my experience, I find that to be best practice, so that way you don't overwhelm yourself, right? All of your homework needs to be completed and in by the 24th. Originally, that was the 19th, but then I realized that the semester technically doesn't end until the 24th. And so April 24th will be the last and final day I can accept anything. That includes any type of quizzes, homework, anything that's outstanding, really. Any questions, comments, concerns? Vote for Lorena. Elias?
Yeah,
Thank
we already
you.
did vote.
Thank you,
You
Valerie.
voted for her? Oh, good.
Yeah.
Okay, so if you think of anything, just feel free to shoot me an email. You know, I'm quick to respond. Also, just a last final note, please, if you have not already, I would really appreciate it if you can complete the course survey. That would be very, very helpful for me. I appreciate you.
We already did mine. Just
Thank
did
you,
it.
Val. Appreciate that.
Thank you.
Great. Thank you, Lorena. Okay, so if there is nothing else, I am happy to help answer any questions you might have. In the meanwhile, feel free to shoot me an email. And I gotta say, it's been an absolute pleasure having all of you in this course. I really enjoyed our time together. I think that we had a great semester, you know, even though we had a little bit of that was online. I really do appreciate having all of you in class, and I think that we had developed a really good relationship. And so even after this class, as you go on and you graduate and you go on to other classes and so forth and so on, I really want you to stay in touch with me because I want to see how you all are doing. And if you need help getting work or, you know, anything like that, let me know. I'll be happy to help you out. I have contacts in a lot of different industries, and you know, I'd be more than happy to pass your resume along or help you with your resumes, and you know, whatever you need. I'm here for you long term, not just through this class.
Thanks, Professor.
We appreciate it.
Professor.
You're the realest, Dr. B.
My pleasure. You know, I'm here for you guys no matter what. So I look at you all as, you know, being a part of who I am because you're the reason why I'm here, right? So and so therefore I want to be with you in the long run. So I appreciate y'all.
We appreciate you, Professor.
Thank you so much. We appreciate you too. You're a really cool professor.
You're a real professor.
Yeah, my pleasure.
Professor, appreciate you.
All right, y'all. Well, I hope you enjoy the rest of your week. And I'm looking forward to a short review session on the 21st. And then I know you'll all do very well on the exam.
Thank you, Professor. See you later.
Thank you so much.
Take care, y'all.
Everybody enjoy the rest of your semester, your summer and everything.
All right. Thanks, you too. I'm sure we'll be in touch.